The Science of Boxing. Dear co-investors, 2024 was a rewarding year, one that not only produced strong results, but reinforced the principles that guided them. Our portfolio delivered a return in euro of 30.2% gross and 24.5% net of my performance fee. Depending on the timing of your capital contributions, your individual results may vary, but they will align over time. For reference, over the same period, the MSCI All Country World Index returned 25.3% and the S&P 500 returned 32.8%, both on a net total return basis, including dividends in euro. The gains in the indexes came mainly from investors paying even higher prices for already expensive assets as optimism grew. Our results stem from buying deeply undervalued businesses that became less undervalued as fundamentals improved and pessimism faded. As index returns are likely to revert toward their long-term averages of 7 to 9%, I am confident our approach will generate significant outperformance. However, our goal is not to chase the indexes, but to maximize absolute returns while minimizing risk. The indexes serve simply as a yardstick, a reflection of the alternative opportunities available to all of us outside this operation. Outperforming them over the coming decades would already validate this as a worthwhile investment in relative terms. Still, it will merely be a byproduct of my commitment to making it an exceptional one in absolute terms. That is also reinforced by my performance structure, which rewards me more for strong absolute returns and less for modest ones with no fee charged on the first 6% of annual gains. The rest of this letter is dedicated to giving you a better sense of how our capital is deployed to achieve these and future returns. Rather than providing a shallow overview of every holding, I will first outline the core principles of my philosophy and then illustrate them in practice through a detailed look at one of our major holdings. How do I invest? My philosophy of investing is the same as my philosophy of fighting. It's all about hitting without getting hit. You keep the distance, pay attention, observe your opponent closely, see how he acts and reacts, get a feel for his movements, a feel for his rhythm, his strengths and weaknesses. You throw a few jabs, straight punches with a weaker hand, not to score, just to test his patterns. You stay alert and ready, and at some point you get an opening. An opening where your opponent overextends, is inattentive, not reacting correctly, and you can swoop into a position where you can hit him, but he can't hit you. That's when you put in your weight and go for the big swings. That's where real knockouts happen. But the true key of being a consistently winning fighter is never having risked being knocked out in the first place. To just charge forward, hoping the opponent won't get you, is either reckless or naive, oftentimes both. It is not the approach of a professional fighter, but of a barroom brawler. As Castamado, legendary trainer and mentor to the great heavyweight champion Mike Tyson, always emphasized, remember, throw the punch where you could hit him, but he can't hit you. That's what the science of boxing is all about. To me, that's what the science of investing is all about. Hitting without getting hit. In investing, it's obviously less physical. Though a 30% drop on a full position sure feels like a gut punch. Don't ask me how I know. As an investor, you read a lot, you think a lot, you speak with many smart, ideally even wise people. Consumers, suppliers, employees, other investors, board members, CEOs, even your mother-in-law. Really, anyone whose view helps fill in the gap in your model of the world. Which frankly, is just about anyone if you are paying attention and asking the right questions. You study many different companies, their history and business models, how management thinks and executes, and their valuations. Occasionally, you develop a feel for the dynamics at play, what's strong, what's weak, and what the market believes. Follow closely for long enough, and sometimes you're lucky to get an opening. A sell-off, a panic, a dividend cut, an earnings miss, an overemphasized hiccup in operations leading to negative headlines, or just a macro shift that pulls capital out of one investment into another. A setup where the valuation is low enough that you don't need to be right about the business being great, or even your thesis playing out, because all the negative is already priced in. You find yourself on the side of your opponent, him facing straight. He can't hit you, but boy, can you hit him. That's when you really go for it. Or, as Customato put it, from the side, you can let that punch go with the worst kind of intentions, because you know he can't hit you back. So you can throw the bomb with all the power you can generate. And that's exactly what I'm doing. Throwing the bomb from the side with all the power I can generate. That's why I take a sizable position once I've identified such a rare asymmetric opening. The beauty of investing, unlike boxing, is that you don't have to engage every round. You only risk getting hit when you swing, when you commit capital. Therefore, you can wait until you're sure you have that kind of opening where you can hit, but he can't hit you. That's a structural edge no fighter will ever have. But that's not how most people play the game. In investing as in fighting, observers are drawn to the big hits, the one-punch knockouts, the newest high-flying stock. This largely forms the image of what a good investment looks like. But that picture is dangerously incomplete, because it's derived only from the outcome, not from the risk taken to get there. Just like the barroom brawler can land a lucky punch while leaving himself wide open, an investor can produce impressive returns while ignoring the downside. Each makes for a great story, but both get knocked out when their opponent knows what he's doing. And while our opponent, Mr. Market, is fortunately inattentive at times, sooner or later he gets it right. And when he does, you'd better be correctly positioned, because he does pack a punch. What do I aim for? So far, we've talked about the strategy, how to fight, when to stay back, when to strike, and how to avoid getting hit. Now let's turn to what I aim for when I do strike. In investing as in fighting, a single clean punch to one area can be enough for a knockout. But a well-placed combination across multiple areas is the safer bet. Here again, we benefit from our structural advantage over the fighter. While he has to work against the clock and has to make do with what he's given, we don't. We can wait. We can be picky. So when I strike, I aim to land the kind of combination that makes up what I consider a high-quality business. Not just strong in one area, but hitting across multiple dimensions. This combination enables such companies to earn high returns on the capital they put to work and to reinvest those earnings at similarly high rates over long periods. The dimensions I look for are A. A long growth runway. The ability to grow tomorrow's earnings by expanding the business. Traditionally, that happens by reinvesting today's profits back into the operation. If, as a newly part-time American, I'm almost obliged to use this example, we owned a lemonade stand. That might mean opening new locations, entering new neighborhoods, or hiring more friends to stay open longer. In contrast, some modern capital-light businesses grow with little additional investment, often driven by network effects, where service improves as more people join, like Facebook, or products that scale at minimal cost, like software. The best of these businesses use the capital, infrastructure, and know-how developed in one domain to expand efficiently into entirely new industries, like Apple moving into music, Amazon into cloud computing, or China's Tencent expanding from messaging and gaming into payments. That kind of strategic reinvestment is ultimately a management achievement. Which brings us to B, a strong owner-operator. As an entrepreneur, I learned that it matters less what you do than who you do it with. The right people unlock upside. The wrong ones turn even a clear path into an obstacle course. That's why we back the right people. High-integrity owner-operators who make decisions that strengthen the business for the long term. Not by always getting it right, but by learning, adapting, and allocating resources in ways that generate more capital than they consume, or at least tilt the odds in that direction. This often means prioritizing resilience and long-term payoff over short-term profitability, a trade-off Wall Street rarely appreciates. That disconnect is what creates our best opportunities. If our lemonade stand is run by a founder with skin in the game, he'll protect the business with safeguards like hygiene standards and backup systems while relentlessly improving it, experimenting with recipes, cooling systems, sourcing better lemons, refining layouts and locations, always watching cost, always improving, never putting the core at risk. C. A growing competitive advantage. This advantage makes it increasingly difficult for other players, even those with deep pockets, talent, and iron determination to replicate the business and erode its position. This advantage can take different forms, ideally combining several of the following. First, the ability to deliver better or more reliable products or services as the business scales, due to experience, customer data, or operational excellence. As our lemonade business expands and we refine our recipes, supply chains, and quality assurance, our customers can expect not just more choice, but a consistently better lemonade. McDonald's wins the same way, not by being exceptional, but by being exceptionally consistent and never being terrible. Second, a structurally lower cost base, enabling the company to offer lower prices while preserving profit margins. Scale brings bargaining power. We might lock in entire lemon harvests years ahead at prices competitors can't match. Third, a strong brand that builds trust, loyalty, and perceived value, even for a commoditized product. Imagine this: our Stoetic lemonade becomes a cultural statement, a symbol of identity and values. Suddenly, we're not just selling lemonade, we're selling what it means to be Stoetic. You bet we could charge an extra $1 for that. Think Red Bull. People aren't buying sugar water, but a statement about who they are or who they want to be. Fourth, structural barriers that limit competition by design, such as patents, licenses, regulations, or exclusive access. These can take the form of privileged shelf space, key real estate, concessions, government approvals, or exclusive partnerships. Such barriers do more than protect the product. They create distribution advantages others can't easily replicate. Imagine we secure an exclusive right to sell our lemonade in the local football stadium. Or better yet, a government license to be the sole seller in certain neighborhoods. That's not just protection, it's a built-in edge in access, pricing, and scale. Fifth, lock-in effects and switching costs that make it inconvenient or costly for consumers to leave. Over more than a decade building and operating enterprise software ventures, I've seen it up close. Multi-million-dollar companies clinging to ancient systems that actively harmed their business, simply because replacing them would have been even more painful. D. Operational independence. One of my earliest clients, an old-school businessman who later became my partner and now an early co-investor with Stoetic Capital, always said, "I never allow myself to be held hostage. The businesses we invest in do the same. They avoid fragility by keeping multiple supply paths, minimal debt, diversified funding sources, redundant infrastructure, and the adaptability to pivot when needed. They refuse to be at the mercy of macro shifts, politics, or regulation. They build flexibility into their DNA because they understand something most spreadsheet warriors don't. The world of business is inherently unpredictable beyond first principles." How do I recognize an opening? Now that we've talked about strategy, hitting only when you can't be hit, and aim, what combination to go for when it's time to swing, the next natural question is, how do we know when it's time to swing? How do we recognize when such a rare opening is in front of us? As we have heard plenty from the teacher, it is only fair to let the student speak. Tyson puts it best. Athletes are like negotiators. They just know it when they see it, from their experience, from doing it over and over for years. You just see it. You come into a room, you just know it. You smell it, you feel it. Exactly. This is what it feels like when identifying the kind of opening we've been talking about. It is instinct, sharpened by experience and guided by discipline. We enter investments when they're deeply mispriced. And while mispricings can have many origins, recognizing the opening always involves viewing the facts from a different angle. More precisely, we see the facts, as we see the world, through a story. One that makes the complex graspable by assigning weight to what matters. Markets have always told themselves stories, but in the ultra-connected age of social media, they travel faster, echo louder, and harden more quickly into consensus. While often true, or rather approximating truth, occasionally the weighting gets skewed and remains largely unquestioned, especially as the obsession with short-term news flow draws the attention to each breaking detail, which is interpreted to confirm the prevailing narrative and distracts from questioning that narrative itself. That is why a perspective removed from the noise, one that allows for independent weighting, is so valuable. For the investor who can uncover the real story, one whose internal weighting of what matters is closer to truth, that misalignment can represent a great opportunity. To make the complex graspable, let's look at it through a story. The story of a major holding. Biglari Holdings. Sardar Biglari started early. At 18 in the 1990s, he launched his first internet company, selling it 4 years later in the midst of the dot-com bubble. With the capital from that sale, he founded a hedge fund at 22, joined by his former finance professor. The fund soon made its mark by taking control of the loss-making fast food chain Steak & Shake in 2008 and turning it profitable within a single year during the Great Recession. The cash flows from the burger business became the fuel powering his next investments. Inspired by the Berkshire Hathaway model, if you see the website sometimes a little too literally, he turned the once money-losing restaurant chain into a diversified holding company, reinvesting mainly in fully owned operating businesses and opportunistically taking minority stakes in publicly traded companies. Still working together with his partner more than 25 years later, he has built a track record featuring numerous examples of what I would call intelligent capital allocation. Turnarounds, while part of the firm's origin story, no longer play a meaningful role. The focus today is squarely on undervalued companies with stable, predictable cash flows, but little in the way of sex appeal, apart from the men's magazine Maxim. See image. Since taking control of Steak & Shake, Biglari has transformed its operating earnings from a loss of $82 per share in 2008 into a profit of $102 per share in 2024, turning the once struggling chain into what is now Biglari Holdings, a group of 7 core operating businesses. The market, however, does not see its majority owner and CEO as a reincarnation of Buffett-like resilience. At best, he is viewed as an eccentric. At worst, a charlatan. His approach and the structure of his companies look unusual at first glance. But after deep research, I found little to support the narrative of self-dealing or hidden enrichment. On the contrary, he communicates the central questions of his business with unusual clarity, transparency, and simplicity, more so than almost any manager I've come to know. Even his compensation structure mirrors my own. While unusual for a publicly listed business, it aligns his incentives perfectly with ours as shareholders. And given the high watermark, we are unlikely to pay him additional compensation for quite some time. Having met him on several occasions, I can attest that Biglari Holdings is his life's work, one he pursues with rare tenacity and intensity. He fights with his gloves off, pun intended, avoiding market trends and staying firmly within areas he knows deeply. His approach can at times appear overly aggressive, but given the choice, I prefer that determination over the opposite. So what do we actually have here? A company with diversified, predictable cash flows, led by an owner-operator who has historically proven his ability to create value through disciplined capital allocation. The next question is simple. What is this business worth? Or put differently, what would a reasonable buyer pay for it? Much of that depends on the manager's ability to keep growing the company's earnings and net worth at attractive rates. The more money he generates in the future, the more we are willing to pay today. As a reference point, Berkshire Hathaway, the gold standard, though a far larger business constrained by its size, trades above 20 times the earnings from its operating businesses. To keep things simple, let's value Biglari Holdings at a conservative 12 times its operating earnings. If the manager performs anything like he has done in the past, that valuation should be higher. Now, what valuation did we actually buy at? Remember those opportunistic minority stakes in public companies? These include 4 fast casual and fast food companies, plus Ferrari. At the time of our purchase in early 2024, that stock portfolio alone was worth more than the market price of the whole company. The rest, the fully owned operating businesses, such as Steak & Shake, Maxim, the Western Sizzling restaurant chain, and subsidiaries in oil and insurance, all came for free. While I have my thesis on the manager's ability to grow the company's net worth and earnings, and therefore on what the business should be worth, I could be wrong about almost everything. The profitability of the operating businesses, the growth of its investments, even management destroying capital. Yet, all of that is already priced in. We are in a position where we can't get hit. But if I'm right, the upside could be enormous. This could very well end up as a knockout for the books. The kind you only need a few of in a lifetime. Thank you for your continued trust. Lawrence. Disclaimer. This letter is provided for informational purposes only and does not constitute investment advice, an offer, or a solicitation to buy or sell any security. Past performance is not indicative of future results.